Hi, I'm Paul Jackson, President of Centurion Advisors Corp. Located in Sugar Land, Texas. This is a short introduction video outlining the various portfolios we offer on our asset allocation platform. Our asset allocation portfolios can be considered a one-stop solution for a fully integrated investment strategy using mutual funds, ETFs, and other diversified investments. The portfolios require a $100,000 initial investment, and each model fits a specific investment risk profile for different types of investors. The three main super asset classes we integrate into the portfolios are equities, alternative investments, and fixed income, consisting of bonds and cash equivalents. All strategies have the potential for profit or loss. When we look at asset allocation, we accept the notion that the majority of return in each portfolio is determined by the asset allocation decision, those percentages of equities, bonds, and other investments we select at the onset. This asset allocation decision is determined by each investor's specific time horizon, liquidity needs, income requirements, and tax considerations, among other relevant factors. We also ensure that each investor accepts the fact that each of our risk models is based on a long-term investment perspective. Taking this long-term perspective reduces some of the fear and panic that takes place in short-term bear markets. Rather, we welcome these bear markets as opportunities to take advantage of mispriced broad markets to position portfolios for a longer-term strategy. To ensure that our asset allocation is implemented correctly, we follow a disciplined fund selection process that will be explained in just a minute. Lastly, since we don't make knee-jerk reactions to market movements, the only thing that should really ever change an investor's risk tolerance is their own personal financial condition. Given this, let's take a quick look at our portfolio options on the asset allocation platform. The standard options run from aggressive growth all the way down to capital preservation. Within each of these models is a 20% change in the mix of equities and bonds, with aggressive growth being 100% equities with no fixed income, down to capital preservation being 20% equities and 80% bonds. The alternative assets we have mentioned would fit right in the middle of equities and bonds since they are not highly correlated with neither asset class. One additional item is that our global growth model is the same as our regular growth model in that they are both 80% equities and 20% bonds, except the global growth model has an additional bias to invest more into foreign markets, both on the stock and bond side. So with the increase of equities as you go up the spectrum comes the increase in expected risk, which is why the aggressive growth strategy has a time horizon of 10 plus years, and the capital preservation strategy has a time horizon of 3 years or less. Along with the increase in expected risk comes an increase in expected return. So basically, the longer the time horizon, the higher the expected risk and expected return for the entire investment period. Lastly, we do have what we call a retirement income portfolio, which was developed for our clients that are currently in retirement and have a specific required level of income they would like to receive periodically over time. Taking a look at major asset classes and their subcomponents, first, equities we use in portfolios range from different market capitalizations and geographic locations. We also from time to time are able to make small investments in special equity classes we feel have a good short to mid-term opportunity to capture additional return. On the fixed income side, we utilize different duration and maturity asset classes in corporates, treasuries, and municipals when appropriate. Also, foreign bonds, both developed and emerging markets, play an important role in certain markets. Lastly, certain market conditions, both in equity and interest rate environments, will prompt us to hold other bond investments like high-yield bonds and floating rate issues. Lastly, alternative assets play an important role in reducing the amount of expected risk in portfolios over time and in different market environments. Strategies such as managed futures, real estate, and specialty equity situation funds are used in different market environments to attain this goal. When it comes to fund selection to fill the asset classes we want the portfolios to have exposure to, we use the same filtering process that is utilized to select long-term options in the retirement plans like 401k plans we advise. Some of the criteria we look at are attaining low expenses, above average peer performance, below average risk, the age of the fund, and the tenure of the current manager. In summary, as previously stated, we accept the notion that the majority of long-term success in an asset allocation model is determined by the super asset classes we implement. The rest is determined by security selection and a very small portion by luck, or as we call it, market timing. We understand that markets will always move up and down, but sticking to a discipline that is determined early on will allow the best chance for long-term success. If you would like to learn more about our asset allocation portfolios and how they can be implemented into your own investment plan, please contact me for more information at either 281-207-5485 or at paul@centurionadvisors.net. Thank you for your time, and I look forward to meeting with you in the future.